We all think of business growth as the ultimate goal, right? More sales, bigger market share, that's success. But what if I told you that the very act of growing could be the thing that brings a successful company to its knees? Today we're going to pull back the curtain on a hidden financial trap that comes with expansion and show you how even the most promising companies can fall right into it. It sounds completely backwards, doesn't it? How can getting more successful be a problem? But that is the central question for today's explainer. We're going to see how rapid growth, the very thing every entrepreneur dreams of, can create a serious and sometimes even fatal cash crisis if you're not paying super close attention. Let's dive in. And this all comes down to what's known as the growth paradox. The logic is actually pretty simple, but it's incredibly powerful. To make more sales, you need more stuff, more assets. You're going to need more inventory on the shelves, maybe more machines to make your products, and you'll definitely have more customers who owe you money. And guess what? All of those assets need to be paid for right now. Success literally costs money. To make this all feel a bit more real, let's invent a company and follow it along. We'll call it GrowthCo. By walking through its financial planning process, step by step, we'll see exactly where the pressure points show up and how a smart company can actually forecast a financial storm way before it hits. So, how does a company like GrowthCo even begin to figure out what the future looks like? Well, they need a model. And one of the most common, most straightforward tools out there is called the percentage of sales method. It's really just a way to build a financial forecast based on one key driver: what you think your sales are going to be. All right, here's a quick snapshot of GrowthCo as it stands today. It's a nice, simple, profitable business. They've got sales of $500, costs of $434, and that leaves them with a healthy net income of $66. This is our starting point, our before picture. Every projection we're about to make is going to start from these numbers right here. Okay, so the core idea behind this whole approach is the assumption that most of your costs and most of your assets are directly tied to your sales. It makes sense, right? If your sales go up by, say, 10%, your inventory costs will probably go up by about 10% too. It's a simple idea, but it's a really powerful way to start painting a picture of the future. And GrowthCo, well, they've got some big plans. The management team is gunning for an ambitious 20% increase in sales for the next year. Now, this single number, this is the trigger. It's what's going to set everything else in motion, and it's going to reveal the hidden problem at the heart of our story. So what does a 20% jump in sales actually do to the income statement? Well, this projected or pro forma statement shows us exactly that. Sales climb up to $600. Costs, which we assume stay at the same percentage of sales, rise to over $520. Now, the good news is net income goes up to almost $80. And of that new profit, GrowthCo plans to reinvest about 2/3 of it, that's about $53, right back into the business. On the surface, everything looks fantastic. But, and this is a big but, profits are only half the story. The other half is the balance sheet, which has to balance. That extra $100 in sales needs to be supported by more assets. And this right here is where we start to see the gap. And boom, here's where the problem just pops right out. If we assume that assets need to grow at the same rate as sales, that means GrowthCo is going to need $600 in total assets to support its $600 in sales. Okay, but where does that money come from? The company started with $500, and we just saw it generated another $52.80 in retained earnings. That only gets them to $552.8. Uh-oh, the two sides of the balance sheet, they don't balance anymore. In the world of finance, this shortfall has a specific name. It's called the external financing needed, or EFN for short. And it's exactly what it sounds like. It's the new money the company has to find from outside sources, like getting a bank loan or finding new investors, just to support the growth it has planned. For GrowthCo, in order to hit its big 20% target, it has to go out and find an extra $47.20 in cash. That is the funding gap. That, my friends, is the real cost of growth. This whole idea leads us to this fascinating concept. Every single company has a financial speed limit. Yeah, just like a car. A business can only grow so fast based on its own engine, its profitability and its financial policies, before it needs to pull over and refuel with some outside cash. And there are two key speed limits you really need to understand. The first one is the internal growth rate. This is the most conservative one. It's how fast you can grow using only the cash your own operations generate, no outside help. Then there's the sustainable growth rate, which is a bit more common. This is the maximum speed you can maintain without selling more ownership in your company, by using a mix of your profits and some new debt. So for GrowthCo, its internal growth rate is just 9.64%.
Now think about that. This means if it wanted to grow without taking a single dollar from a bank or an investor, it would have to cap its big ambitions at less than half of its 20% goal. That's its true self-funded speed limit.
But now, look at its sustainable growth rate. It's over 21%. This tells us something absolutely crucial. GrowthCo's 20% goal, it is achievable. It's just under this maximum sustainable speed. But, and this is the key, it can only get there by taking on new debt to cover that $47 funding gap we found earlier.
So does that mean these speed limits are just fixed, that you're stuck with them? Not at all. As this quote says, a company's ability to grow is a direct result of the choices its managers make. And this is where financial management stops being about just crunching numbers and becomes a powerful strategic tool.
So how can a manager actually change their company's speed limit? Well, you can think of it like operating a machine that has 4 distinct levers you can pull.
Here they are, the 4 big levers. First up, profit margin. Basically, become more efficient and make more profit on each sale. Second, asset turnover. Use the stuff you already own more efficiently to squeeze out more sales. Third, financial policy. This means changing your mix of debt. Taking on more can increase your leverage, but it also increases your risk. And fourth, dividend policy. This one's simple. Keep more of your profits inside the company instead of paying them out to shareholders. Pulling any of these levers can increase your sustainable growth rate, but each one comes with its own trade-offs.
All right, so let's just quickly recap the crucial points we've covered. Number 1, growth is not free. It costs real money. 2, simple tools like the percentage of sales method can help you see that funding gap, the EFN, before it becomes a crisis. 3, every business has an internal and a sustainable growth rate. Think of them as your financial speed limits. And maybe, most importantly, these limits are not set in stone. You can absolutely manage them with smart financial policy.
And that leaves us with one final big thought. Whether you're running a massive global corporation or a tiny little corner store, these principles are exactly the same. Understanding the link between how you run your business and how you fancy it is the absolute key to healthy, sustainable expansion. So let me ask you, what's your business's true speed limit?